Hi, this is James Shug with Westpac London's end of day report for Friday the 12th of July. Although I'm actually doing this at the weekend, I wanted to incorporate some of the latest news on France. Portugal first though, the opposition leader there, who was invited by the president to form an interim government with the coalition government that's currently struggling, having lost some of its key ministers last week. The opposition leader insisted that the austerity measures that the administration had put in should be wound back to quite a significant extent, and that meant that markets took the view that it was much less likely that there'd be a smooth transition back to market access as scheduled in June next year, when Portugal was due to exit the bailout. Now, bond yields spiked towards 8%, they're up about 80 basis points, that's 10-year bond yields. Given that Portugal's only paying 3.2% for their bailout funds, that would involve a much more costly funding of their existing debt. And of course, if austerity measures are unwound, there would be higher deficits to cope with as well. So Portugal very much looking fragile. Just a few weeks ago, it was one of the poster childs for how austerity could be implemented, and how it could help restore access to financial markets. Having said that, Ireland has seen its rating outlook upgraded to positive because by one of the agencies, on the argument that the effort that Ireland's put into place is actually generating some decent results, and maybe they'll actually be able to pay back some of the debt that they've incurred through the bailout, and indeed some of their existing debt ahead of schedule. On the French issue though, Fitch stripped France of the AAA rating. That means that all three of the major agencies have now done that. They cited the subdued economy, at best flat, possibly slightly in recession, and prospect of further acceleration in government debt, and only distant prospect of reduction in government debt. And basically it's rising, or already risen, beyond the level that's consistent with AAA status in terms of debt to GDP. So, I mean, indeed, the whole sovereign debt crisis looks like it has the serious potential to fire up again going forward. We had some slightly weaker economic data today, on Friday, with the 0.3% fall in industrial production. Not really a surprise, that was for the Eurozone aggregate, given the partial data we'd seen from various countries. But it coincided with ECB Council member Cour saying that there was a risk that the recovery, which the ECB staff forecasts currently have beginning in the second half of 2013, i.e. around about now, that the risk that recovery could be delayed a few quarters. He even said that there was some risk that a Japanese-style lost decade could be in store for Europe going forward. Although I think he meant a low risk, but nevertheless something that wasn't totally impossible. And the fact that ECB's chief Draghi at his press conference earlier this month said that the economy was still contracting, but at a slower pace, it does show that the ECB is recognising that the downside risks to their growth outlook are really crystallising, and it adds weight to the view that they really are serious about the various non-standard measures that they could still implement in an effort to address the flawed transmission of monetary policy to peripheral states, and indeed the more general weaker growth outlook. Our view at Westpac is that there'll be a substantial balance sheet expansion, i.e. the ECB will take on more risk as part of that policy response, although that would have to be in conjunction with European governments agreeing on a very firm national government backstop for a banking union that is making good on banks that needed recapitalisation. That would be cross-border, of course, so Germany would have to acquiesce on its current reticence to fund other European governments' obligations to their banking sector. So you just keep your eye on Europe. We've got issues, of course, in Spain with the corruption allegations there around Rajoy. The Greek bailout continues to be problematic. Cyprus, of course, still in difficulty, and so on. So the broader picture, I think, is one of markets not yet fully recognising the seriousness of the situation in France, but recent price action pushing up bond yields, particularly in the periphery, suggests that there is growing recognition that there is a significant problem ahead. In the US, on Friday we saw the PPI rise 0.8%, gasoline prices, a big part of that. The core was up 0.2% with auto prices somewhat higher. So a little bit of inflation creeping in there, which is what the Fed wants to see at the moment. The Consumer Sentiment Index from the University of Michigan, the preliminary July read, showed a slight fall. The current index actually rose to a new cycle high, but expectations were quite a bit weaker. So those are the main news stories on Friday. Markets were little changed actually. The Dow was, the Dow just up 0.02% at 15,464 at the close. London market actually up the same amount, just 0.02% flat. French market down 1/3%. The Germans up 2/3%. Spain was off 2.3% and Italy down 1.6%. The commodity markets saw oil prices up about 1% at $105.95 a barrel. Copper was down about 0.75%, and the gold price was pretty much unchanged. It's at $1,277 an ounce. And the Aussie dollar, it actually dipped early Friday trading just below 90 cents to 89.95, although it closed at the end of the New York session on Friday at 90.5 US cents. Right, so that's about it for this week, and indeed for a little while I'm shifting down to Westpac's Melbourne office, although I'll still be doing the London economist role, and we do hope to fire up these daily reports once we've got the technology sorted down there. So apologise for the lack of future reports to the extent that it takes some time to get that sorted. Okay, but until then, bye for now.